It's the moment you've all been waiting for. We're going to talk about retirement. So for the retirement process, we're going to talk about a number of topics. This part of the day is probably best geared for those members that are really considering retiring in the next couple of years. So we're going to talk about choosing a retirement date, when you have to meet your obligations with your district versus what you need to do with the retirement system. We're going to talk about the death benefit. I just want to remind you because it is a separate benefit from the pension. We're going to talk about the pension options. So when you file for retirement, you're going to choose an option. So we're going to talk about those options. What are they? How do they work? Who chooses those options? We're also going to explore the possibility that for some of you, it may be a better option to buy private life insurance than to choose a pension option. So we're going to talk about what you would need to know, what you would need to consider in order to perhaps go that route at the time of retirement. We're going to talk about taxes. We're going to talk about the NYSTRS cost of living adjustment. And we'll also talk about working in retirement. So how does NYSTRS keep track of your earnings in retirement? What are the limits and what's a waiver? Who gets a waiver? What do you need to do to get a waiver? And we'll cover all that in this next section. Now, how do you go about choosing a retirement date? Sometimes it's confusing. A lot of folks call and they say, hey, do I retire on June 30th? Do I retire on July 1st? Well, a good rule of thumb is we can't pay you at a time that the district is still paying you. So whenever your contract ends, and for most of our teachers that would be June 30th, you're resigning your position, filing for retirement, telling the district you're moving into retirement, and then you actually file for retirement with the retirement system for a date of July 1st. So you end your employment on June 30th, retire on July 1st. How soon do you have to submit your application? Well, the retirement system won't take it any earlier than 90 days before your effective date of retirement. And there's no prizes for filing early. As a matter of fact, there could be some advantages to delaying filing a little bit closer to your actual date of retirement. When we do an estimate for a member, we project all of their future service and salary. We assume you're going to work every day, that you're going to earn all the money you're supposed to earn. But the reality is that when you file for retirement, you will not have worked, perhaps April, May, or June. So we won't consider that service or salary until we get the information from the district. So your initial benefit calculations, which will be in effect for the first 9 to 12 months that you're retired, will only reflect service through the date that you filed. Once we finalize your benefit, we will, of course, retroactively pay you any monies that we shorted you during that processing time. Now you are able to decide how you would like to file for retirement. We take a traditional paper retirement application. We still like paper here at the retirement system, but we do offer an online version through your NYSTRS account. A few times during this presentation, I probably will stress how nice it is to have a NYSTRS account. It's just super useful, both leading up to your retirement and even in retirement. Lots of great tools that will be super helpful for you. Now, the online retirement application, there's a few advantages to that. So I'm kind of selling it here because it often will keep members from making some of the most commonly made errors when completing the paper application. So you'll have to take my word for it there. In addition, you do not require the signature of a notary with an electronic submission, and you also do not have to send it by certified or registered mail to know that we've received it. So one is not better than the other, but there may be some advantages to filing online. If you do submit a paper application, make sure that it's notarized correctly, and we wouldn't require it, but we certainly would encourage you to send that by certified or registered mail. So when it comes to choosing a retirement date, there are really two important timeline items that I want you to be aware of. The first is the law allows you 14 days after your effective date of retirement in which you can rescind your application. Essentially what you'd be doing is telling us that you've changed your mind and you don't want to file for retirement. Now that is a very different thing than getting your job back with your district. The retirement system does not have the power to give you your job back. So should you find yourself in a situation where you have decided that you want to move into retirement and now you're being given an opportunity where you are going to work full-time or earn a good salary working for a New York State public employer, you may want to have that service credit and salary added to your membership. So you've got 14 days that you can stop that retirement process and continue work with a public employer to enhance your public benefits. The most important milestone or timeline item really is 30 days. So you may be filing for retirement as early as April for a July 1st date of retirement. So you've got several months before your date of retirement comes. but the law allows you 30 additional days, so in this example, close of business on the 31st, in which you can change your mind about your option. So you want to ask yourself in those 30 days after your date of retirement, am I still healthy? Are my life circumstances still the same that pushed me towards making my original decision? I want to make sure that you all understand that this 30-day window is really important. I want you to take full advantage of it, really think thoroughly through this period of time, because once those 30 days have passed from your effective date, the law simply does not allow a benefit change. So you cannot change your mind about the option, and in some cases you're locking yourself into a specific beneficiary. So make sure you take full advantage of that. You should know that even if you have a compelling reason why you want to change your option, the law does not allow it. So make sure that you take advantage of this 30-day window. Now, death benefits and pension options are two separate things. I talked earlier about the fact that you're currently protected by an active member death benefit, but that for those in tiers 2 through 6, there's a continuation of that death benefit in retirement. So it is a reduced benefit, 50% of the 3 times your last year's salary in your first year of retirement, 25% of 3 times your last year's salary in your second year, and then it remains at 10% for the remainder of your lifetime. So this death benefit is a one-time payment. It's a freebie death benefit. There's no reduction in your pension to provide that. An option is something that you will get to choose when you file for your pension benefit. So you can take the maximum benefit where there are no payments to a beneficiary, or you could choose an option that would allow you as the member to receive less money each year for the promise of some type of a benefit payment to a beneficiary upon your passing. There are 4 primary options that you can choose. There's the maximum benefit, the lump sum option, guarantee period options, and then survivor and pop-up survivor options. If by the time you're listening to this video, you have received your prep workbook, now's a good time to get it. It may be easier to follow along with the options section if you follow along with the example that we provide in the workbook. If you would prefer, you can pull out your benefit profile from this previous year. Within, we provide an estimate of your benefits. That may give you a better sense of how much of a reduction from the maximum you would take in order to provide the different types of benefits to your beneficiaries. If you're following along with the workbook on page 46, you'll see an estimate. It's just a sample for a member we call Mary member. Now, Mary is a 55-year-old female, and her designated beneficiary is a 58-year-old male. So within the estimate that we provide in the workbook, or if you get an estimate sent to you from the retirement system, it always shows the member name, date of birth, the retirement date chosen, and also the ceased teaching date, so the last day that you were on payroll. It would also show the service credit. So in this example, you can see that Mary has 30 years and 3 months of service. Her pension factor is 60.5%. So she gets 60% for the first 30 years, and those 3 extra months of service gave her an additional 0.5%. So 60.5% of the final average salary of $70,000. That gives her the maximum benefit. So for everyone, when we take the pension factor against the final average salary, apply any age factor that might exist, we get the maximum benefit. And in Mary's case, it's $42,350 a year. Now, the maximum benefit is the highest possible benefit any retiree can receive. It's payable for the retiree's lifetime, and it stops at the time of the retiree's passing. So there's no promise of a benefit payment from the pension to any beneficiaries. So who takes this option? I can tell you that about 65% of our membership takes the maximum benefit. Now, don't be fooled. That doesn't mean that it's the best option. What that means is that it meets the needs of more of our members than any other option. So it's a great option if you don't have any beneficiaries, or perhaps your beneficiaries are fully independent. Maybe you have other assets. You have large 403Bs, you own property, maybe private life insurance. Sometimes you're a dual pension household and each of you takes the maximum because you don't feel like you need your pension to continue on for the surviving spouse. And sometimes you take the maximum simply because you just need as much income coming into the household as possible. So the maximum benefit provides the highest possible benefit that you can receive annually, but there are no payments to a beneficiary. We're going to talk about some other options that you could select that would provide various types of benefits to beneficiaries at your passing. The first we're going to talk about is called the largest non-declining lump sum. The largest non-declining lump sum is exactly that. It's the largest one-time payment that you can designate to a beneficiary to receive upon your passing. It's got some flexibility in that you can name multiple beneficiaries, and for as long as you're living, you can change those beneficiaries. So who chooses this option? Generally speaking, it's a member who's not expecting to live a long time. It's an expensive option. It's an option that requires a fairly significant reduction from your maximum. It still provides a lifetime annual benefit to the member, but it's a great option for someone who's not eligible for private life insurance because it is an option that we provide that is most like a whole life insurance policy. This is a good way to protect your family if you're unable to choose private options. I do show the declining reserve here. It's something that was available to Tier 1 members only, and they have a designated dollar amount for their declining reserve start point, and each year that they live, they have their annual benefit deducted from that, so kind of debiting from the account. At the time of their passing, any account balance that remains is paid to the beneficiaries. So this is the example of the largest non-declining lump sum payment to a beneficiary. So again, we're going to use Mary Member's example. Her maximum benefit is $42,350. If she chooses the largest non-declining lump sum option, she would instead receive a lifetime annual benefit of $34,174. She would receive that dollar amount every year for as long as she was living, and at the time of her passing, whether she lived 1 year or 30 years in retirement, the designated beneficiary would receive a one-time lump sum payment of $505,361. You can see it's a significant reduction from the annual maximum. It does have that flexibility. Again, you can designate multiple beneficiaries, and throughout your entire life in retirement, you're able to change who those beneficiaries are. The system does recognize that a member may like the idea of leaving a lump sum benefit to a beneficiary, but may want to choose an option that would allow them to have less of an impact on their annual benefit. So maybe not the largest non-declining lump sum, but just another lump sum dollar amount. The system provides a cost per thousand, and the cost per thousand is based on your age at the time that you retire. So here's an example of an alternative option lump sum. Again, Mary Member's maximum benefit was $42,350. The cost per thousand, which is determined by her age at retirement, is $16.18. So let's say that Mary wants to leave a one-time lump sum of $100,000 to be paid at her passing to her beneficiaries. It's a literal translation. So for each $1,000 that she wants the system to pay to a beneficiary, she would take $16.18 from her maximum. So if she wants $100,000, it's 100 times the cost per thousand, $16.18, or $1,618 annually. We would simply take the maximum, $42,350, subtract the cost of the option, $1,618, and Mary would receive for her lifetime an annual benefit of $40,732. She would receive that every year for as long as she was living, and upon her passing, her designated beneficiary would receive the one-time lump sum of $100,000. The third option we're going to talk about is the guarantee options. Now, the guarantee options are probably the most commonly misunderstood option that we offer. They function similarly to a term life insurance policy, if you're familiar with that. So essentially how this works is that the member agrees to receive a smaller reduction in their annual pension, so it's not a terribly expensive option, for the promise that the system will pay the benefit for no less than the guaranteed period. So is it still a lifetime benefit for the member? Yes. The member always gets a lifetime annual benefit. So let me give you an example. Let's say the member's maximum benefit here is $42,350, and Mary decides to take a 10-year guarantee. She's going to agree to receive the reduced benefit of $41,829 per year for her entire lifetime. Starting on the date of her retirement, the guarantee window would begin. So she would start to receive $41,829, and the clock starts. So let's say Mary were to tragically pass away 6 years into retirement. She had a guarantee of 10, so the system would have paid her benefit for the first 6 years of 10, and then the benefit payment would transition to the beneficiary for the remaining 4 years of 10. So it doesn't transition to be a lifetime benefit to the beneficiary, it just pays for the remainder of the term. Now, if Mary outlives the term, so let's say Mary has great longevity and she took a 10-year term, but she lives, 30 years. At the time of her passing, there's no payment to a beneficiary because she would have outlived the guarantee. And once the guarantee period is over, your benefit payment does not increase back up to the maximum. So it stays at a small but lifetime reduction. Now, who takes this option? This is an option that's almost always chosen by someone who needs to cover a gap. Sometimes it's from 55 to 65 when Medicare kicks in. Sometimes it's folks that are moving into retirement that still have a significant amount of debt, that if the pension were to stop early on, it would cause a financial hardship. Sometimes it's because a member's just very fortunate and moving into retirement at a very young age, and they may still have children in elementary or high school or college, and they're concerned that should they pass away and the pension were to stop, that would interrupt the education of their kids. So these are just a few examples. There's many, many reasons, but it is kind of a specialty option and not perfect for everyone. The last option is a survivor or pop-up survivor option. Now, these are options that will continue a member's benefit onto a beneficiary for the remainder of the beneficiary's lifetime. So it is a very generous benefit to offer to someone that you love. You can only name one beneficiary. So when you choose both a survivor or a pop-up survivor, you can only name one beneficiary, and the beneficiary can never be changed. So it's important to understand that there's no flexibility when it comes to the beneficiary. You do have that initial 30-day period that I mentioned earlier from your effective date of retirement in which you could change the option or the beneficiary. But again, once that 30 days has passed, there's no ability to change that option. You're not required to choose 100% of coverage. You can choose any percentage that you want, but we provide the cost for 100%, 75, 50, and 25% in all of our estimates. There is a survivor and a pop-up survivor, and they are very similar with one significant difference. I'm going to explain the difference to you in just 1 minute. So who takes this option? Well, it's almost always chosen by someone who has a spouse that doesn't have retirement savings of their own. So it's a great option if the family unit is really relying on this as the only source of income in retirement. There are limitations on how high of a percentage you can choose for your pension to continue on to a beneficiary if you choose someone who is not your spouse but more than 10 years younger than you. So for an example, let's say you were trying to choose a grandchild or a young adult child. You wouldn't be able to choose 100%, and if you met with me, I might try to discourage you from doing that. But that's another story altogether. You might have to meet with one of us to know why. Okay, I can't leave you hanging. I have to tell you why. So to figure out the cost of an option for the survivor and the pop-up survivor, they take into account actuarially your age and gender, and also the age and gender of the beneficiary. So if you're choosing your spouse who's of similar age, it's going to be a reasonable cost for you to choose them as a survivor or a pop-up survivor option. If you choose a young child, the system's looking at that actuarially and saying, okay, we're expecting we're going to have to pay you as the member for a period of time, but now that you've chosen a designated beneficiary that's a lot younger than you are, the system's going to have to pay the benefit for many, many more years. So it'll be more expensive for you on the front end. It could be a significant reduction in your annual pension. So if you're going to choose someone who's not of similar age as for a survivor or a pop-up survivor, make sure that you have estimates run before you choose that. So here's our example. You can see Mary's maximum benefit is $42,350. Below that, you'll see the survivor and the pop-up survivor. On the left, you see percentages. The percentage represents how much of your pension would continue on in a benefit payment to the beneficiary. So under the survivor at 100%, you can see that Mary would receive $38,716 a year. She would get that benefit every year for as long as she was living, and should she pass away, her surviving beneficiary would get $38,716 per year. So she's truly giving her benefit to the beneficiary. If you go down to a smaller percentage, let's say 50%, you can see the member's benefit goes up, $40,452. So the member's benefit goes up because she's providing less protection to the beneficiary. She would get $40,452 per year, And if she passed away, her surviving beneficiary would get 50% of that amount annually, or $20,226. With the survivor option, you can choose one person only, and it can never be changed. If your beneficiary predeceases you as the member, your benefit amount remains the same. So you can't designate a new beneficiary, and your amount remains unchanged. The pop-up survivor functions very similarly. So you can see the percentages. At 100%, the member would get $38,344. So you can see it's a little bit more of a reduction in the benefit. And if they passed away, the surviving beneficiary would get the same amount, $38,344. The difference with the pop-up is that if the beneficiary dies, you still can't replace it and put a new beneficiary in, but the member's benefit goes back up to the maximum, the $42,350 maximum. So you only have that reduction from the maximum for as long as you have a viable beneficiary. If the beneficiary predeceases you, your benefit amount goes back to the unreduced maximum. So who takes this option? Well, it's almost always, again, someone who has a spouse that needs protection. And you can do varying degrees of protection. And I often point out to members that this decision should be done like a math problem. That sometimes when we're talking about protecting beneficiaries, it feels very, very emotional. And so much of what we've been talking about today has been math, this percentage of that and this factor. But the reality is that you want to provide for your beneficiaries what they need. You don't want to do this out of some sense of obligation. You want it to be, you've done your homework, you know how much money needs to come into the household, and you choose an option that works for you. Just as an example, you can see that the difference between 100% survivor and 50% survivor is only a few $1,000s. But the difference for the beneficiary is much more significant. So I've had members ask me in the past, why would I do that for just a few $1,000s a year? And I like to tell them, you're on a fixed income in retirement, and $2,000 extra a year might mean 2 trips to California to see your grandchildren. So you don't want to downplay the value of a few $1,000s to provide benefits to a beneficiary that doesn't need the additional monies. So I always want you to be thinking, carefully about that. I've also heard from members that they can't understand why someone wouldn't take the pop-up, that the pop-up is a really nice piece of protection. And I can't disagree. If you and your spouse are of similar age and there's no reason for you to know that one of you would predecease the other, it's a great piece of protection. But if you are the member and you are in poor health, or you think that there's no way that your beneficiary will not outlive you, then there's no need to buy that insurance, and you can choose the straight survivor option. So this is the breakdown through 2018. So the maximum benefit, about 65% of our membership takes the maximum. You can see the pop-up and survivor options combined come in second place. The guarantee option, kind of a specialty option there, and the alternative option category is sort of strangely large. And the reason for that is because anyone who has a domestic relations order or a court order through a divorce to divide a benefit falls under that alternative option category. Now, if you've gotten to that point in your retirement planning where you've started asking around, what option did you take? What's the best option? You may hear others say that they've been advised or they've decided to buy private life insurance. So take the maximum benefit where you're getting the highest possible benefit, and instead of choosing an option to protect the beneficiaries through the pension, to choose private life insurance. So what are some things that you need to know about life insurance? Well, life insurance payments generally are a one-time lump sum, a large payment that the beneficiaries then annuitize. They receive a small portion of that dollar amount every year for the rest of their expected lifetime. Now, there's some advantages to the private life insurance for sure. One of which is that it's super flexible. So you can designate more than one person, you can change the beneficiaries, you can cancel the coverage. Sometimes there's a cash value associated with it. So lots of flexibility that may not be with some of the options that are offered through the retirement system. One of my favorite benefits of life insurance is that those beneficiary payments are almost always non-taxable. So you're giving your beneficiaries this gift of comfort and security, and they don't have to pay taxes on that money. So what are the drawbacks? Why might not that be the best idea? Well, because your own age and your health are significant factors in how expensive it is. So you can talk to an insurance company and you can tell them, I'm super healthy. I don't drink. I don't smoke. I don't have heart problems. I only eat kale. And they're not going to take your word for it. They're going to take your blood. So you have to go through an underwriting process and be, given these insurance policies. So someone giving you an estimate may not be the actual cost of the premium. If you're listening to this video, I think it's also very likely that your option of whole life insurance affordably is gone. So you're probably looking at term policies, 10, 20, 30-year terms. If you choose a shorter term, it would be less expensive for you to do that, more affordable, but you could outlive the term, and then you'd be looking to re-up, buy new insurance at a point in your life when it would be more expensive and more difficult to get coverage. So there's pros and cons, but those are some of the pros and cons of private life insurance. For our purposes, we're going to compare that to 100% survivor. So no pop-up survivor, just straight survivor. So what are the highlights of a survivor option? Well, the clear highlights is that it gives guaranteed lifetime monthly income for both you and then the surviving beneficiary. And additionally, the cost of that coverage is fixed at the time of retirement. So, it's deducted from the pension, pre-tax, essentially, the cost of the option is deducted. What are the downsides? Well, it's pretty clear. It is super limiting. So you can only choose one beneficiary. You can never change who that beneficiary is. The member and beneficiary age are both factors in the cost of that option. And something that most people don't consider is that when your survivor starts to receive that monthly benefit, it's taxable just like it had been for you. So, if you were paying X amount of dollars in taxes and now your surviving beneficiary is receiving that payment, they will continue to pay taxes on that as well. So the first place you have to start if you want to consider private life insurance is trying to figure out how much it would cost you to take an option from the pension. I know that seems a little bit backwards, but I'll explain why. So let's say she took the maximum benefit. Her maximum benefit, $42,350. Let's say we withheld federal taxes for married zero, so we're withholding $3,301 per year. So her net benefit payment under the maximum is $39,049. If she took the survivor option, she'd be getting less every year. 100% survivor option would pay her $38,716. We would, again, withhold for federal taxes married zero at her request, so $2,870 a year. So you can see there's less tax because the benefit is smaller. And then the net benefit payment is $35,846. So now you have these numbers. What do you do with them? Well, if you subtract one from the other, the net cost of the option is $3,203. So when you start shopping for private life insurance, in order to get something that's better than the survivor option, you would have to be able to pay less than $3,203 per year in insurance premiums. The next big question is, well, how much insurance do you have to buy? I mean, do you need to buy $100,000 to make it comparable to a survivor option? Do you need $1 million? Well, that's going to depend on how much money you want your beneficiary to be able to take from it every year. And the insurance industry provides these factors. So essentially what they're doing is you're telling them how much money you need your beneficiary to live on, multiplying that by 12 to come up with an annual amount, okay? And then you're using the factors below based on how many years you want them to be able to receive that benefit. So if we're going to do apples to apples, let's use the 30-year factor because we want them to be able to collect a benefit of the same dollar amount that they'd be getting from a survivor option for 30 years. And that is 15.52. So going back to our example, if she took 100% survivor option, her beneficiary would get $38,716 per year. So that's what she would get with 100% survivor. So she needs to get a lump sum dollar amount in a life insurance policy that would be large enough that over a 30-year period, she could withdraw $38,716 a year. So you take that $38,716 a year, you multiply it times the factor for 30 years, 15.52. So in this particular case, she would need a life insurance policy of at least $600,000 per year for a dollar amount less than $3,200. So that's really the math that you'd be doing for yourself. Now, if your pension that you would be replacing is $60,000 or $70,000 or $80,000 per year, then the lump sum dollar amount you would have to have in a life insurance policy would be also exponentially higher. So you need to do this math for yourself. This is just the sample. Many of you already have existing insurance policies through your union or private insurance policies. So you have some great resources out there that you can consult about either expanding existing policies or changing policies, or maybe taking out a new policy to protect your beneficiaries in retirement. You can start with your union or an association sponsored plan. Those are great places to start shopping. If you have a local insurance agent, you can certainly check in about getting a new policy or bundling with some other type of policy. The bookstores have shelves of books about life insurance, and the internet is a great resource if you are ready to buy. The internet feels gloriously anonymous. I promise you it is not. So here's just an example of an estimate that was done several years ago by a coworker of mine. So you can see here that it shows, monthly annual costs for term policies. So 10-year, 20-year, 30-year. So he was looking for $1 million policy. He was quite young when he did this estimate. So I'm sure he said he was young, healthy, and good looking. So you can see that these are all really affordable policies. I never want anyone to assume that they can get the coverage that they want inexpensively. You need to do this shopping before you file for retirement. You don't want to assume that you can buy private life insurance, file taking the maximum benefit, only to find out that you're uninsurable because you had a pre-existing condition or suffered from some type of illness or cancer early on in your life that makes you now uninsurable. So do this homework ahead of time. For many of you, especially those of you that are moving into retirement when you're young and still healthy, private insurance is a great option to look into. Insurance can be a little bit cruel, so once you've reached the age of 60 to 65, the blocks of insurance tend to get smaller and more expensive. So if you've worked a nice long career and you're over that age, or 62, 63, 64, the possibility that you can choose this as a better option start to go down. So make sure you do your homework. I'm not discouraging anyone from trying this. I'm just encouraging you to do some shopping. Additionally, if you are, putting all of your eggs in this insurance basket, you want to make sure that the company that you go with has, a good rating. You want to make sure that they've been assessed by a company like AM Best, Fitch, Standard & Poor's, Moody's, Weiss Research. These are all companies that are able to rate insurance companies essentially on their ability to pay their promised benefits. So something being a less expensive policy may not necessarily be better. At the end of the day, if you're going to be paying premiums long term, you want to make sure they're able to pay the promised benefits when they need to. So let's assume that you've made your decision about when you're going to retire and you know what your options are going to be. You might want to know how you're going to get paid. Well, we're going to pay you once per month, and we're going to pay you by direct deposit. So you're going to tell us your banking information as part of the application process. And if you retire in July of 2020 on the 1st, you're actually going to get your first pension payment on the 31st of July. So welcome to summer money. 12 months a year, last business day of the month, you will always receive that payment. The direct deposit form is fairly self-explanatory, so you can fill out a paper application as part of your retirement application, or if you file online, you'll fill out this information online. We pay once a month, and then we also run payroll once per month, and that generally happens in the middle of a month. So if you need to change your banking information, you can do so as often as you need to, but we would need the information changed by the middle of the month so that the payment that we pay out on the last business day goes to the new account. Taxes are always a happy topic when it comes to talking to retirees. Your pension is federally taxable, but there are no New York state taxes, no Social Security, Medicaid, so no FICA taxes. And that's a huge savings for you going forward. Now you can update your withholding at any time. So when you initially file, you're going to tell us how you want us to withhold for your federal taxes. Obviously, you don't have to fill out anything for New York State because your pension isn't taxable by New York State. But you can update your tax information at any time, as often as you need to, and you can do that online as well. Now, New York State does not require that you pay state-level income taxes on your pension. But if you decide to, in retirement, relocate to another state, make your primary residence in another state, you will always be subject to the laws of that state. The states that you see listed on the left-hand side, these 9 states, do not have personal income taxes on wages, pensions, or Social Security. So you can see that there's the perennial popular Florida there. But you'll also notice that there are several states that are very popular relocation states for retirees, states like North and South Carolina, Virginia, Georgia. Those states are not listed here. So you can assume that if you relocate to those states, that those states will require that you pay state level taxes on your pension. Now, I do want to say that you want to make sure that you fully investigate taxes in the state that you're going to be moving to. You may pay less in property or school taxes, and that may offset some of the taxes that you have to pay on your pension. So make sure that you do your homework. The states that you see on the right-hand side, Alabama, Hawaii, Illinois, Mississippi, Pennsylvania, they tax certain types of income, but currently exempt public pensions from tax. So just make sure that you're in the know. There's some great resources available for you to do some investigating on state level taxes. We've listed some websites that may be helpful as you start to research taxes in other states. RPEA is a great website to go to. It's very comprehensive, pretty easy to use, pretty intuitive as far as helping you navigate the system. Retirementliving.com is another site, and the portal at Kiplinger is an additional site. So these are all three sites that will help you to figure out all the information that you need to know about taxes should you make your primary residence in another state after retirement. In case you were wondering, NYSTRS does have a modest cost of living adjustment, or a COLA. Before the COLA will kick in, you have to be both retired for 5 years and be the age of 62. So someone who's retiring at 55 will not see the first cost of living until they reach the age of 62. It's based on the change in the Consumer Price Index, and it's guaranteed to be at least 1% to as much as 3% of just the first $18,000 of your pension. Really, that translates into increases of somewhere between $15 and $45 per month if your pension is at least $18,000 per year. Prior to 2001, there was no legislation that guaranteed a pension increase after retirement. Periodically, the legislature would pass some law that would allow an increase for those members that were currently collecting a pension. But in 2001, they made that a guarantee. It's a modest increase, but the members who are experiencing the cost of living adjustment since 2001 have seen a monthly increase in their pension of about $363. So it does what it's supposed to do. It's supposed to help to offset the cost of living, but it certainly will not keep pace with inflation. So you want to be mindful of that, but certainly it's wonderful to have these periodic increases in your pension amount. So the last big topic of the day is going to be talking about earnings after retirement. So many of our retirees do make the decision to have some type of employment after they move into retirement and start collecting their pension. There are certain categories where there are no limitations on your earnings at all. So if you're working privately, federally, out of state, or as an elected official, we do not restrict those earnings. If you're working in public work, but you have already reached the calendar year that you're going to turn 65, we also have no limit on your earnings in public work. If you haven't reached the calendar year that you're going to turn 65 and you want to have employment with a public employer, the new limit, effective just this past fall, is $35,000 per calendar year in New York State public employment. So it's per calendar year. So if you're retiring in July, that limit doesn't start until you actually move into retirement. So you could earn the full $35,000 from July through December, and then in January, the new $35,000 limit would cover you from December to January. Now, we want you to be careful of these limitations because NYSTRS is required by law to suspend your pension if you exceed the limit. So NYSTRS must suspend the pension once we receive notification that you've exceeded the limit until one of two things happens. Either you demonstrate to us that you're no longer working in public work or the new calendar year begins. So I've often asked the question, does that mean that I can't take a position where I will earn more than $35,000? So I want to break it down for you. NYSTRS provides many tools that you can use to keep track of your earnings in retirement. Online in your My NYSTRS account, there's a section there that you can actually keep track of all of your post-retirement earnings. So that would include any public employment, not just education facilities that report to NYSTRS. So you're going to want to keep track of any town, village, county, if you're working for a SUNY college or a community college, those are all public monies. So we want you to make sure you know that those are all counting against that $35,000 limit. Let's give you an example. Let's say that your own school district has asked you to come back because they have a long-term sub replacement and they really just can't find anyone else to do it. But they're going to pay you more than the $35,000. Let's say they've said they're going to pay you $40,000 to do the job from January through the end of the year. So can you take the job? And the answer is yes, but you have to be mindful of the limitations. So in January, when you start working for the employer, you'll be collecting both your pension and money from the school district. February, pension, money from the school district. March, pension, money from the school district. And this will go on until you get to the point where you're going to hit the $35,000 limit. When you know that you're going to hit the $35,000 limit, it would be your obligation to then notify NYSTRS in writing that you are at the $35,000 limit and you need to suspend your pension. So you would ask us to suspend your pension, and so from that point, let's say it's the end of April or the beginning of May, from that point until the end of the school year, you will only receive monies from the school district. You will have suspended your pension. You'll no longer get money from your pension until June 30th, when the position ends. You can contact NYSTRS and say, I'm no longer working in public work. Please restart my pension. So it's a little bit of a nuance on that. You can technically earn more than $35,000, but you can't be earning over the limit while still collecting your pension. So I hope that that example helps a little bit. Now, if you are in a position that's difficult to fill, you do a job that they can't find another non-retired person to do, the employer has the ability to seek a Section 211 waiver. Now, a 211 waiver is an opportunity for an employer to seek permission from their governing body to allow them to hire someone who is a retiree and allow them to earn over the earnings limitation. There's both limited and unlimited waivers that can be granted. You can never get an unlimited waiver in your home school district, so you are unable to retire from your job and then go back and collect your full pension and collect the full salary in your own employment. As a matter of fact, most of the time when a waiver is granted, that's granted for a period of 1 year, and it's almost always used to fill just kind of a gap period. So very often it might be an administrative position. The school district needs a new superintendent, so they put out a year-long search, for a talent search to get a new superintendent. In the interim, they hire an interim superintendent who very often comes in from another school district and works for that 1 year period under a waiver. It's possible to also get a limited waiver, and a limited waiver is just that. It limits the amount of money between your maximum benefit and the salary that you could earn under that position. So it allows you to exceed the $35,000 limit, but in many cases not significantly. So again, a Section 211 waiver is possible, but if you're teaching second grade, you're not going to get a 211 waiver. You're going to get a 211 waiver if you're in an administrative position or if you're working in a specialty education position. So right now we've seen some come in that are in high-level math, science, some of the foreign languages, certainly certain technology positions where the talent isn't out there right now looking for jobs. So the employer is able to make the case to, let's say, state education department that they must hire you to do the job. So if you fall into one of those categories and the employer wants to hire you, it would be up to the employer to seek the waiver. So NYSTRS does not administer any health insurance. So if you have health insurance with your employer, you need to actually point all of your questions to them. Now, the coverage and the cost is all part of your contractual agreement with the district, so you really have to ask them questions for that. As a matter of fact, I would also tell you that there's some other questions you should be asking them. First and foremost, what happens when you sign up for Medicare? There's a Medicare reimbursement. Is that going to come from the retirement system, or is that going to come directly from the school district? Get more information about the type of coverage that you have. You might have fantastic coverage here in your local area where you live, but if your dream is to move out of state, you want to make sure that that coverage is going to be good out of state as well. To cut costs, or as a cost savings measure, I should say, many employers use insurance policies that use preferred provider networks. So in your local area, there's lots of coverage and you can, get all the help that you need inexpensively. But that same policy, because you're out of network in another state, may not provide adequate coverage or even any coverage that's non-emergency. So you need to have an answer to that question as well. The third question I would encourage you to talk to them about is, can I make changes to this once I move into retirement? Can I add people? Can I remove people? And what happens when I do? So make sure you ask your employer all of those questions before you need to know the answer. You don't want to wait until there's an issue to ask all of that. We try to make sure that we are keeping our retired members in the know. So just because you've moved into retirement doesn't mean that we stop communicating with you. So once your retirement has been completed, the processing has been completed, you'll start to receive a retired member profile each November. It's much abridged. It's basically just giving you your basic information, telling you what your option was and who the designated beneficiary may or may not be. So it's just to keep you refreshed about what information you have. Now, additionally, you're currently getting a Your Source newsletter. In retirement, you'll get a resource newsletter. So 3 times a year, you get it through your NYSTRS account. It's a great resource. In my experience, I find that a lot of our retirees really enjoy reading it, and they often call and ask questions about it. So we'll be here to answer questions should you have any. So if this is your year, there's a few things I really want you to do, and this is my retirement checklist. My NYSTRS is amazing. It has a ton of information. It is incredibly convenient for you, and it is super secure. I always tell people it's like Fort Knox, so you're the only one who's getting in there. So register for my NYSTRS account if you don't already have one. When you get your most recent benefit profile, read it, look at it, look through it, not just how much your pension is going to be, but make sure that all the salary and service information looks correct. Make sure that's the beneficiaries that you want to have listed. Make sure you keep control of that situation for as long as you can. Scan your brains for prior service. Every bit of service that you have done that's creditable here, we want you to have. It will enhance your pension benefit for your lifetime. If you can get to an individual consultation, we would encourage you to do that. It's a great opportunity, whether you do a phone consultation or a video consultation, whatever is available the most quickly or most conveniently for you, I would encourage you to take advantage. It's a really nice experience. It's about a half an hour. If you get one that's close by, you can kind of scoot out for lunch and maybe come back. And it's a really good experience. You'll have a much better sense of what your net payment will be, how much money you can expect to live on in retirement. If you can't get out for a consultation, at least call us and get an updated estimate. All the estimates that we provide to you make certain assumptions that you got certain raises and they may not be as accurate. If you have all of the information that's going to cover you, all of your contractual information from now until the day that you're going to retire, if you provide that information to us over the phone, we can send you an estimate that's going to be very accurate. So don't be afraid to do that. Or if you have a NYSTRS account, you can actually run estimates for yourself at any time. So some people take full advantage of that. I always like to see that when I look at the NYSTRS accounts, but a lot of folks don't realize that that's a benefit that's available to them. Review your health insurance coverage with your employer. We went through some of those questions that you need to ask them. And you must, and I cannot stress this enough, you must actually file for retirement. So simply resigning your position and having the cake in the party is not going to start your pension benefit. The only time that starts is when you tell us that you are ready to retire by filing an application for retirement. People separate employment all of the time. That doesn't necessarily trigger retirement thoughts for us. So if you want to be receiving a pension, you need to get that application to us, and it doesn't take a long time. As I mentioned, we get you on payroll very quickly. So, we want to make sure that everyone doesn't miss out on any possible pension payments. Thank you so much for listening. If you have any questions, the workbook has tons of information, and we are always happy to take your calls here at the Retirement System.